Good afternoon. My name is Jeff Stauffer, Community Relations Director with Elville and Associates, and welcome to today's Advisors Forum webinar, Estate Planning Strategies for the 2020 Election and Other End-of-Year Planning Concerns. We'd like to wish all the veterans and their families a happy Veterans Day today and thank them for their service today and every day. How this will work today, if you're new to our webinars, if you are, welcome. We're glad that you're here. You're on mute. However, if you have questions, please pose them throughout the presentation in our questions panel on the right-hand portion of your screen, and I, as the moderator, will send them to Chuck throughout the presentation. You also received the slides by email yesterday afternoon from me for your convenience to take notes on them if you wish. For certified financial planners, CPAs, and other professionals on today's webinar, you may receive 1.5 continuing education hours for attending. So if I do not have it already for my records and per the requirements of the CFP Board of Standards, please email me your ID number. And specifically for CFPs, I need the last 4 digits of your Social Security number as soon as possible, as I'd like to get our reporting in as soon as possible. As I mentioned in my welcome email yesterday, and some of you heard before, Steve Elville is away recovering from eye surgery and will be out for a few weeks. He does send his very best wishes to everyone and looks forward to being back as soon as possible, probably at the beginning of December. So in his place, I'd like to give a warm welcome to Mr. Chuck Borek, who is presenting for Steve today. Chuck is special counsel to Elville and Associates and founder of the Borek Group, LLC. He is a business and tax attorney with almost 30 years of experience representing individuals, small businesses, and nonprofits. Chuck earned his joint JD and MBA summa cum laude from the University of Baltimore, where he was the editor-in-chief of the Law Review and the recipient of the 1993 Law Faculty Award. He has taught law students as a visiting professor and adjunct professor of law at American University and the University of Baltimore, and has lectured at Dickinson Law School at Penn State University. Chuck has written for Thomson Reuters, Bloomberg BNA, and the American Institute of Certified Public Accountants. His book on contract drafting is used by lawyers throughout Maryland and has been cited by the Maryland courts. Additionally, Chuck presents seminars to CPAs and lawyers around the country through his company, the Borek Group, LLC, including presentations to Big Four accounting firms and Fortune 500 companies. He lives with his wife, the youngest of his 4 children, and 2 dogs in Howard County, and is currently pursuing graduate work in theology and literature at Wesley Theological Seminary in Washington, D.C. Everyone, you're in very good hands with Chuck today. I've worked with him in webinars before, and he's just a great presenter, and he's very, very busy on the webinar circuit, and we appreciate Chuck stepping in and for his expertise today. So I'll go ahead and turn it over to Chuck. Thanks for being here, Chuck, and thanks everybody for being here as well. Chuck, it's all yours.
All right, thank you, Jeff, and welcome everybody. Today we're here to talk about the something that's been in the news. If you've paid attention, there was an election. Seems like it was a long time ago. I guess it was just last week, right? But we've had an election, and whenever there's an election, we are always thinking about what effects that may have on the tax environment specifically. It reminds us, I think, that the tax environment is something that we always have to be flexible with regard to. You know, I think things really have changed dramatically in that regard over the course of my practice. When I first started practicing back in 1993, right, last century, you know, we were in an environment where you could more or less predict what was happening in tax law. Tax law tended to evolve. The policies that were being pursued by Congress sort of ruminated for a long time, and there was lots of discussion and debate about them. And so by the time the law changed, everybody was pretty well aware of what was happening, and nothing really took you by surprise. And I really recognized a change in that probably just about 20 years ago, 15 or 20 years ago, I guess, where there doesn't seem to be as much contemplation with respect to tax law changes. And I think we saw that dramatically in the last couple of years, with the Tax Cuts and Jobs Act at the end of 2017, a dramatic change. I mean, just if you compare that, for example, to the Tax Reform Act of 1986, Tax Reform Act of 1986 was in the hopper, so to speak, for close to 2 years between the first proposals and when it was enacted into legislation. The Tax Cuts and Jobs Act had a lifespan of about, realistically, of about 4 months between when the first proposals came out and when it was enacted. It first saw the light of day in September of 2017 and became law in December of 2017. And then this year, of course, we've seen, we had the Secure Act in 2019, and then all the COVID legislation, earlier this year, it changes things, and they change in a flash. And so we always have to be sort of nimble when we're looking at tax issues from a planning standpoint. Nothing is forever, right? In the Tax Cuts and Jobs Act, they divided changes into temporary changes and permanent changes. Well, permanent in tax law, of course, means simply that that's the rule until Congress decides to change its mind. So there really is no permanence, right? And that's one of the topics I think that we need to think about today. A lot of the important provisions of the Tax Cuts and Jobs Act that affect planning for our clients are set to expire at the end of 2025. Whether they actually expire then or before then, who knows, right? The worst case scenario for a tax planner is uncertainty. Unfortunately, we have uncertainty, and we'll continue to have that for some time. So with that in mind, on that happy note, let's go ahead and talk about or think about the things we're going to talk about today. We'll identify some specific things with respect to tax change where we think tax change may come. We don't have a crystal ball, so we can't predict definitively, but we can certainly identify some areas where we expect change, or where there's at least potential change, and how those changes will affect our clients. Well, just knowing that a change is going to affect our clients doesn't do us any good, and doesn't do our clients any good. They want to know what to do, so we need to think about strategies that would be available to our clients. One of the big issues this time of year, and will continue to be a big issue at this time of year, would be, or is, whether or not we should engage specifically in end-of-year exemption planning. Right? We have an historically large unified credit or exemption from the estate and gift tax right now. The same exemption applies separately, of course, to the generation skipping transfer tax. Well, that inflated exemption, if everything goes as planned, right, won't decrease until 2026. But as I said, who knows? We have presumably a new administration coming into Washington with a new policy agenda. They may or may not have sway in the Senate. So all of those things are unknown, and those things could change dramatically what happens in the area of tax law, and specifically in the area of the unified credit or exemption. How does the tax change or the potential changes affect the planning documents? One of the tricks when we do estate planning documents for our clients is to make sure we incorporate flexibility to the extent we can. Sometimes, there's only so much you can do, but, as we draft documents, we understand that, things may change, that's why, for example, the quintessential example of flexibility in drafting is the disclaimer will, right? Where we utilize disclaimers to try to do post-mortem or set ourselves up for post-mortem planning to respond to the tax law at the time. So, and that's a very important thing to work with legal counsel on, because legal counsel obviously is doing the drafting. Planning, by the way, in my view, should always be a team effort. I think we're long past the day when clients could go to their financial advisors for just specifically financial advice, and then independently and separately go to their lawyers for the estate planning drafting. It just doesn't work that way. Clients, we put these problems, we divide these issues, these topics into separate buckets because it's easy for us to do that, right? It's much easier to focus on one particular area or one particular type of topic. And in fact, the world has become so complex that that's really a necessity, right? We have to do that. But problems don't really come in nice little packages like that, right? Clients come to us and they have property transfer issues, and they have family dynamic issues, and they have financial issues, and they have tax issues, and all of those issues are intertwined. And so a holistic approach where multiple advisors are all sort of keeping their eye on the ball, I think is really certainly optimal and almost required today. So when we finish up our discussion, we'll talk about next steps and some available resources, and certainly I'll be happy to answer your questions, as Jeff said, through the chat box, the chat function on our webinar today. All right, so I mentioned the Tax Cuts and Jobs Act. Of course, Tax Cuts and Jobs Act greatly increased the statutory amount for the exemption, right? Excuse me. Increase the exemption to $10 million. Now remember, there's really two different exemptions, right? There's one exemption of $10 million that applies to the estate and gift tax, right? The unified estate and gift tax, and the generations giving transfer tax, which is a separate tax altogether, also has a $10 million exemption associated with it. One big difference that's important to understand in those two exemptions is, there's a lot of talk after the Tax Cuts and Jobs Act about portability. And so we can actually, for a married couple, we can effectively double that exemption. There's no portability with respect to the generation skipping transfer tax exemption. Furthermore, the $10 million statutory exemption, of course, is indexed for inflation. So it's really not $10 million. In 2020, it's $11,580,000. Which means that effectively, with proper planning, a couple can access $23,160,000, and the surviving member of that couple can utilize that $23,160,000 through proper portability usage. Now, portability, by the way, only applies right to your unused exemption amount. That's a question we're going to talk about today. Should you use your exemption amount? There's no extra credit for keeping your exemption amount until you die. It may very well be prudent to use up that exemption amount during your lifetime in order to leverage gifts and perhaps preserve a larger amount that's sheltered from the estate tax upon your death. As I said, at the end of 2025, under current law, the exemptions are slated to go back down to $5 million. Presumably we have a new president, right? I know there's lots of discussion in the news, but I'm going to make the assumption that we have a new president, and we're going to, we need to take into account what his approach has been. The president-elect's approach is to increase taxes on the wealthy, and the wealthy are who pay the estate tax, right? The estate tax is not a tax that reaches very far down into the economic spectrum. The number of estates in the United States that pay an estate tax every year averages about 4,000. About 4,000 estates in the United States pay an estate tax. As you can imagine, there are substantially more than 4,000 deaths in the United States, right? So 4,000 is a very tiny fraction, a very tiny percentage of the total estates. Now, when somebody's subject to the estate tax, of course, it's onerous, right? The estate tax is basically a 40% tax. And so planning for the estate tax is crucial if there is any possibility that the estate tax will be applicable to a taxpayer. So we don't reserve estate tax planning just for the wealthy who are definitively in range of having the estate tax applied to them. we need to look at those possibilities for everyone. So what's going to happen under a Biden administration? We don't know. The estate tax itself may change. The whole existence of the estate tax is something that's been debated for literally for decades. Certainly it's possible that at some point in the future, the estate tax could go away. I don't think that'll happen during a Biden administration. The Democratic side of the aisle has been in favor of an estate tax. And in fact, Joe Biden, of course, has promoted increased taxation for wealthier Americans. And part of that might be to reduce the exemption and perhaps even reduce it below the $5 million that it's set to go to in 2026. A number that's been tossed around is 3.5 million, and possibly a separate gift exemption as low as $1 million. Now, that's not unheard of. When I first started practicing in 1993, some of you may remember back then, right? The exemption unified credit was $600,000. So, we certainly could return to that time. They could eliminate the credit altogether, although that's probably not likely. All right. So those are all things we have to think about and consider. The IRS did finalize the regulations on the anti-clawback rules so that a decedent won't be treated as having made a taxable transfer in excess of the exclusion amount at the time of their death if they use it while the Tax Cuts and Jobs Act is in effect and then dies after that. So in other words, we don't have to worry about using it now and then somehow having a clawback where our earlier use of it is detrimental because the amount has been reduced. You're going to get the benefit. The client's going to get the benefit of whatever the exclusion amount is at the time they make the transfer that is to which the exclusion amount is applicable. However, there is the rub. Do you want to use it now or do you want to wait? And if you wait, almost certainly it's going to go down. I would emphasize almost, right? Because as I said, under current law, it's set to go down in 2026. It may go down earlier. It's certainly possible that Congress will extend the current exemption amounts. How much the exemption amount is has a lot to do not just with policy and politics, but with the Congressional Budget Act. That's why we have extender legislation every year. The reason so many provisions in the tax code are temporary is because they've got to meet the Congressional Budget Act requirements. And so whenever there's a tax benefit that's added to the code, it has to be offset by revenues. And typically they can't offset those benefits too far into the future. And so they have to have a terminus, and then they simply, sometimes they simply extend those benefits. So we'll have to see what happens. We really don't know, right? All we can think about, as I said, is in terms of possibility. Another way of thinking about this, of looking at this and thinking about it, is the basis step up, right? Under the current law, when you inherit property from a decedent, you get a step up in basis. And the consequence of that, of course, is your basis is equal to the current fair market value. If you sell the property shortly thereafter, presumably you're going to sell it probably for that fair market value. The value is not going to change that quickly, and therefore there won't be any gain to report from the sale of the property. If there were a step up in basis, and likely there would not be if they were to, if they were to eliminate the estate tax, but even in other circumstances, they may provide that there won't be a step up in basis. Then we have to deal with the difference between lifetime gifts and gifts upon death. Currently, lifetime gifts don't get a step up in basis, right? That's one of the things that we have to sort of balance when we think about lifetime use of the exemption amount. The exemption amount will shelter the transfer from any gift tax or any subsequent estate tax, but it doesn't give you a step up in basis. Again, the president-elect has indicated that the basis step up is something that he's looking at in order to increase Treasury revenues. And that, of course, may have a dramatic effect on individuals who inherit property, property that has appreciated greatly in value. If they don't get a step up in basis even upon death, then you're looking at potentially a large capital gains amount. And even that, remember, the capital gains is still set at a maximum of 20%. That could change at any time. There were proposals not that long ago of eliminating the special capital gains rates and just taxing capital gains at ordinary income rates. And again, that would have certainly a dramatic effect on our clients. So what does it mean for our clients? Well, I think we need to sort of be in a mode of use it or lose it. I mean, under current law, and that's really all we have to go by, right? As I said, we don't have a crystal ball. Under current law, the larger exemption is going to go away at the end of 2025. If we knew for certain that that was going to happen at that time, maybe we wouldn't have such a big concern now, because the exemption amount does go up incrementally with inflation, right? So maybe we wait until it goes up more. Now, of course, as it goes up, you add to the exemption amount. So you could fully use the exemption amount for 2020, for example, and as it increases in 2021 and 22, you could increase your gifts. But the important thing is to consider in the mix lifetime gift planning. And I want to emphasize that, because too often clients and sometimes their advisors have this mindset that I referred to earlier, where they think that they get some sort of bonus, some sort of credit for holding on to as much of their unified credit as possible, as much of their exclusion amount as possible. And that's just not the case. And in many instances, I think it may be prudent to use that up. Now, is it crucial that that amount be used up by December 31st, so that we get it done this year? Probably not. And again, I say probably, I don't have a crystal ball, but generally speaking, it's unlikely that there's going to be a significant legislation passed during the balance of 2020, especially since we're in a lame duck session. If legislation is passed in 2021, it will probably be, substantially into 2021, and it will not likely be retroactive, although it could be. Typically, the history has shown that when they change the exemption amount, you're grandfathered in. They don't have that clawback provision, so that's probably not a huge danger. But if it's prudent in a particular circumstance, if it seems obvious that we want to use that exemption amount, there's certainly no reason to wait, right? We have certainty today. We may not have certainty tomorrow, and so. If the direction we're heading for a particular client is the use of the lifetime exemption, then it probably is prudent to go ahead and use that sooner rather than later. There's lots of other things we can do, and we're going to look at all these different strategies. Intrafamily notes and sales, the swap power for basis management, GRATs or Grantor retained annuity trusts, installment sales to intentionally defective grantor trusts. That's one I frequently have a problem describing to my clients, because they get caught in that word defective. They don't like the idea that their planning has some defect in it. Of course, that's not what defective means in this case. We'll talk about that. Spousal lifetime access trusts, or SLATs, have become popular. People are using two SLATs, a SLAT entered into by each spouse, which may be effective. You do have to be careful, right? Because there is, a doctrine of reciprocal trusts, which may eliminate the IRS's respect for those trusts if you don't do them correctly. So you have to be careful when there's two SLATs involved. And frankly, you got to be careful when there's one SLAT. You got to be careful in all these planning techniques to make sure they're done correctly. And then finally, an oldie but goodie, the Irrevocable life insurance trust, right? I mean, that's something that is sort of a no-brainer when there's a substantial amount of life insurance involved, especially if it's term insurance. I mean, it really is a no-brainer if term insurance is involved for reasons I'll talk about in a minute. All right, so let's look at the interfamily note and sale situation. First of all, interest rates are at historic lows right now, and I really mean historic lows. The applicable federal rate for October for a short-term note, which is a note of 3 years or less, is, I think, 0.14%, not 14%, 0.14%, 14/100ths%. That's virtually zero. And even the long-term applicable federal rate, right, for notes of 9 years or more is, I think, 1.38%, right? I remember back in the old days, my first house, we refinanced, and I was ecstatic that we were able to refinance at a 30-year rate of 10%. I thought, I was on easy street for the rest of my life. How could it get better than that? 10% for a mortgage. It doesn't look so good anymore. I probably should refinance again. I'm kidding, of course. Long since got rid of that 10% note. But the point is, we do have really, really low interest rates now. So you can loan funds to a family member, get a promissory note, charge the applicable federal rate. In fact, if you're loaning less than $10,000, you don't even have to charge interest. But assuming you're loaning more than $10,000, you can charge the applicable federal rate, which is, again, virtually zero. And then the family member, at the very least, has resources available to them at a much lower cost than they would have at a commercial, from a commercial source. And to the extent they earn, they generate earnings on that loan in excess of the paltry applicable federal rate. You have a net gain to the family member. You could do intrafamily sales. If you have an income-producing asset, you sell that to a family member, again, in exchange for a promissory note at the applicable federal rate. And if you do that, the income gets taxed at the, potentially at a lower family member's rate. If you have, let's say, mom and dad are in the, the 37% tax bracket, and maybe we have children that are in the 24% tax bracket. You sell the family business to them. Not only do they pay a very low interest rate, but the income that's produced from the property, from the business, accrues to the benefit of the child at the much lower rate. All right. And again, you have the same issue with the return on investment. To the extent you can invest it at a higher rate, it's all to the better. So graphically, let's look at what an intrafamily sale looks like. You loan money to purchase the asset to a family member, and you sell it at fair market value. So let's say we have a $1 million asset. We give them a 3-year loan at a 1% interest rate. In fact, for a 3-year loan, it wouldn't even have to be 1%. 1% is, what, about 5 times the interest rate that you'd have to charge them today on a 3-year loan. But if we used 1% as an example, right, that very conservative, can't believe I'm saying that, 1%, very conservative loan rate, the amount that would be paid back in principal and interest over the 3 years, $1,016,000 approximately, $1,015,491. Family member just pays that monthly installment amount. You could even forgive some of the payments. Now, if you do that, it's a gift and potentially a taxable gift. So, but that's a possibility as well. Whatever's left over, the family member keeps. In this particular scenario, assuming a 5% rate of return, the family member would end up, the child or whoever we're selling the asset to, would end up with $1,078,952, right? Which means effectively $63,000, a little over $63,000, is transferred to the family member free of any gift tax. Doesn't reduce your gift tax exemption. Nobody pays any tax on that amount. So that's how we can use intrafamily sales in planning. We can always use this, what we call the swap power, in order to manage basis. Remember, if you gift assets during lifetime, you don't get a step up in basis. So by exchanging high basis asset for a low basis asset in an existing trust, not only do you minimize the income taxes, but you take advantage of that basis adjustment at death. So there's no gift tax consequences, no gain recognition, and no, or at least a limited inclusion in the gross estate. And let me show you again graphically what that would look like. So the grantor is going to remove low basis assets from the trust, replace them with high basis assets. Let's say asset number one is worth $1 million, got a basis of $200,000. We replace that with asset number two, which is a $1 million asset, same value as, of the asset, but it's got a basis of $1.5 million. All right. At death, asset number one gets a step up in basis. We've taken that back into the estate, so we're going to pass that through the estate. It's going to get a step up in basis. So assume its fair market value is $1.5 million at that point. The beneficiaries of the estate take a $1.5 million basis in that asset. Asset number one then is sold, and the $1.3 million in capital gains tax is avoided. Right, that's the difference between the $1 million and the or the $1.5 million and the $200,000 basis that the property had. So if the property had stayed in the trust and simply got sold after death out of the trust, would have a $1.3 million gain. The loss of $500,000 on the asset number two that we put into the trust carries forward to subsequent years, and then it ultimately is passed to the beneficiaries when the trust terminates, or of course is utilized by the trust itself if the trust sells the asset. Talk about grants. Grantor retained annuity trusts. A grant, of course, is, as the name implies, it's a trust. It's a trust where the grantor, the settlor of the trust, retains an annuity interest in the trust assets. This, of course, has been used for years to transfer appreciation without having to use the estate or gift tax exemption. The way it works is the grantor transfers the asset with a specific term of years. We need those term of years to be relatively short, however. The one big danger with a grant is if the donor, if the transferor, dies before the end of the term of the grant, the assets come back into their estate. So, ideally, if that weren't the case, we would have 15-year, 20-year grants. But generally, we have 3-year or maybe 5-year grants. The most 5 years even is pushing it a little, in my view. 3 years is more common, at least in my practice. At the end of each year, the annuity gets paid to the grantor. The sum of the annuity payments is equal to the principal investment plus the interest, right, determined under regulations in the tax code, regulations pursuant to the tax code. Any amount remaining is passed to the beneficiaries, and of course, is passed free of any estate or gift tax. And we can use successive grants, right? We can use rolling grants. But again, each grant is going to be a relatively short-term trust. So let me illustrate this graphically. Say the grantor funds the grant, the irrevocable trust, with $1 million in assets at a 0.8% rate. Again, that's even higher than you need to use for a 3-year term. The payments, the annuity payments, would be, as you see on the screen, $279,335,402 for the term of the grant. So we have total payments coming back to the donor of $1,017,016. After the term, whatever's left goes to the beneficiaries. Now, of course, depending on what rate is earned, what the return of investment, return on investment is earned by the assets in the trust, will determine what ends up going to the beneficiaries. In this example, if you had just a 5% rate of return, which is certainly not, unrealistic, $95,000 goes to the beneficiaries, again, free of estate and gift tax. And you can see, of course, that amount goes up exponentially. If you're able to achieve a 20% rate of return, you'd have over $500,000 that you can transfer gift and estate tax free. There are other grant-like strategies as well, of course. QPERTs, qualified personal residence trusts, are distinct because we use a personal resident, and there are some distinct considerations, but they are not terribly different from grants. Installment sales to intentionally defective grantor trusts. Well, I think you have to start here with what an intentionally defective grantor trust is. It doesn't mean a trust that's defective, right? What it means is that the grantor and the trust are treated the same for federal income tax purposes. An intentionally defective grantor trust takes advantage of the fact that we have a different definition that applies to inclusion of assets for income tax purposes, as opposed to the inclusion of assets in an estate for estate tax purposes. An intentionally defective grantor trust is designed as a trust which may exclude the assets for estate tax purposes, but doesn't exclude them for income tax purposes. For income tax purposes, the trust is considered to be a grantor trust. The term grantor trust, of course, means that the IRS does not recognize a distinction between the owner of the assets, typically the grantor, although it could be someone else, and that person and the trust itself. In other words, the trust is invisible to the IRS. The way this strategy works is you set up this intentionally defective grantor trust, you fund it with some seed money, and that's important because what we're going to end up doing is we're going to end up selling an asset to the trust and taking back a note. In order for that transaction to be respected, we generally want to have some down payment, if you will. We want to have some cash in play. And so typically we fund the trust with a gift of 10 to 15% of the value of the assets that we're going to sell. And then any appreciation of income produced by that asset, of course, is going to pass tax-free to the beneficiaries of the trust. The interest payments on the installment note aren't taxable to the grantor because, remember, from an income tax standpoint, the IRS does not recognize the trust. The trust and the grantor are one and the same person. So there's no income when you pay yourself. So there's no income on the payments to the grantor. Capital gains aren't recognized when the asset is sold because, again, the grantor is treated as selling the asset to him or herself, right? So when you sell the asset to the trust for federal tax purposes, you're selling it to yourself, and therefore there is no taxable transaction. So it would look something like this. Grantor gifts, again, that seed money, that down payment money, as well as other assets to the intentionally defective grantor trust. Let's say we have $1 million asset that's going to be sold, and so they put $100,000 of seed money into the trust. They take back a 9-year note with a 1% interest rate, $1,046,000 in principal and income. The grantor takes back an installment note equal to the fair market value of the assets sold. The appreciation of the assets goes to the intentionally defective grantor trust beneficiaries. And again, just like with the grant, the amount that's going to pass tax-free is going to depend on the rate of return that's earned. If a 5% rate of return is achieved, it's $197,000, almost $200,000, right? That is passed to the beneficiaries tax-free. And again, that goes up exponentially under this scenario. Look what happens if it's a 20% rate of return. Over $1 million past tax-free. We can use an installment note, by the way, to leverage that further. We can make a $10 million seed gift to the IDOT, or not the IDOT, the intentionally defective grantor trust. Trustee can purchase up to another $55 million in assets in a family-owned entity, again with an installment note. The appreciation, again, passes to the beneficiaries, and the appreciation passing to the beneficiaries with an inclusion ratio of 0 for GST purposes invokes no GST tax. Remember that the primary planning device for generation skipping transfer tax is that you can set the inclusion ratio of assets in an estate at the time you fund assets in a trust, at the time you fund the trust. So when you fund the trust, you can use your generation skipping transfer tax exemption, which, remember, is separate and apart from your estate and gift tax exemption. You can shelter the full amount of the transfer. If you did that, then the assets in the trust have a 0 inclusion ratio, and then regardless of what they grow to at the end of the trust period, there's no tax, no generation skipping transfer tax when those funds come out. So that's the basic scenario of a generation skipping transfer tax. You fund the trust with money or property. Trustee administers the trust for the benefit of the beneficiaries, typically the children, and then the grandchildren, and even the great-grandchildren. And all of that, of course, comes out generation skipping transfer tax free, as well as estate and gift tax free, of course, because you can also use your separate exemption for that. And then we have SLATs, spousal lifetime access trusts. The concept of a SLAT is that a spouse with sufficient assets sets up a trust for the benefit of their spouse, the other spouse. Obviously, the other spouse, although they're the beneficiary of a trust, they generally live in the same house with us, right? And so the grantor of the trust, at the very least indirectly, is able to benefit from that trust without making it a grantor trust for federal income tax purposes. The key with a SLAT, and the big difference between a SLAT and a Q-tip trust, for example, is that with a SLAT, we can have children as alternative beneficiaries, right? The trust doesn't have to benefit just the spouse during his or her lifetime. We do have to name an independent trustee. They do have to have discretionary power. We can use the exemption when we make the gifts. It won't qualify because it's going to have other beneficiaries, and because it won't qualify as a Q-tip, doesn't qualify for the unlimited marital deduction, so we utilize our exemption for that amount. The appreciation of the assets go to the beneficiaries free of future estate and gift tax. The grantor spouse, again, can use all of their available exemption. Again, it is at historically high amounts now. And as I said, we can have 2 SLATs. Each spouse can create a trust naming the other spouse as a beneficiary. And that's okay. We can do that, right? But we do have to be especially careful in that case, right? You can't just set up 2 identical trusts. There are certain hoops we have to jump through to ensure that the IRS will respect those as separate trusts and not invoke the reciprocal trust doctrine. Also in a SLAT, the other advantage, and this is an advantage with other use of trust as well, is that there's some creditor protection involved. Now, there are various ways that you can inhibit creditors from reaching assets. None of those ways, however, involves transferring assets at the time you owe creditors, right? That's something that you have to be very careful about. If you transfer assets for less than full consideration at a time when you owe a debt, then that can be viewed as a fraudulent conveyance, and the assets can still be attached by the debtor. So we have to be careful. But at a time when we don't have any debts, don't have any claims that we're trying to escape, we have a much broader opportunity to be able to do proper planning and protect those assets from future creditors. So to illustrate a SLAT, grantor funds with money or property in irrevocable trust, just like we start with in the other planning techniques. The spouse of the beneficiary, again, descendants may be additional beneficiaries. At the death of the spouse, just like in a Q-tip trust, the assets go to the additional beneficiaries, typically the children. Now, again, that's very much like a Q-tip. The difference is the children can be beneficiaries of the trust during the spouse's lifetime as well. And then we have what I refer to as the oldie but goodie, right? The irrevocable life insurance trust. All planning sort of begins with that, right? That's planning 101. We transfer a policy to an ILIT or irrevocable life insurance trust. Actually, the better procedure is to have the trustee apply for and obtain the policy from the get-go. And the reason for that is when you transfer the policy to the trust, there is a 1-year period that if unfortunately the transferor dies during that period, it's going to be brought back into the estate. So you do have a limited window of risk. Whereas if you have the trustee obtain the insurance policy, you don't have that issue. Now, of course, the trust has to get money to pay the premiums on the insurance. We do that through gifts to the trust. We set the trust up as another unfortunate term, crummy trust, right? Why do we call it crummy trust? Well, we call it crummy trust because there was a minister in Arizona, I think he was in Arizona, whose advisors, no doubt, came up with this idea. And they said, look, if we set up a trust, which is when you make a gift to a trust, it's a gift of future interest. The problem is that the annual gift tax exclusion only applies to a gift of present interest. And so this minister or his advisors came up with this idea that, well, if we make a gift to the trust, but we notify the beneficiaries and we allow the beneficiaries some reasonable period of time, 30 days, to come and get that money if they want. They can just take it without trust. They can just take it from the trust. And if they don't do that, then the trust will keep it and pay the premiums on the life insurance. The argument was that converted the transfer to a present interest gift, and therefore the annual gift tax exclusion applied. The IRS fought that, but ultimately lost, and the IRS ultimately acquiesced to the Ninth Circuit opinion in that case. And so we've been able to use this technique ever since then. That minister had the unfortunate last name of Crummy. He was the Reverend Crummy. And that's why we call them crummy trusts, right? So it has nothing to do with a defect, right, or with the quality of the trust. It's a crummy trust because the Reverend Crummy was the case that sort of launched the idea. Now, I said earlier, this is kind of a no-brainer, especially with term insurance. And I'll qualify that just a bit. And the reason I say that is because, worst case scenario, you transfer the life insurance policy, or you own this life insurance policy inside a trust. What if you decide, remember it's an irrevocable trust, so what if you decide you want to change beneficiaries? What if it turns out that some of your beneficiaries no longer need the money, or circumstances have changed, so you want to change beneficiaries? Well, it's an irrevocable trust, so you're stuck with it, except certainly if it's term insurance, the easy solution is we just stop paying the insurance, we let the premiums lapse, we start a new trust with a different policy. Now, of course, the only caveat there is, there could be a issue with the insurability of the transfer, so that's a possible risk. And the same is more or less true even if you have a cash value policy. The only difference is we've got to get the cash out first, so it's a little bit more complicated. But it's irrevocable life insurance trust planning is simple. It's straightforward. There are some like with every other type of planning, you got to make sure your T's are crossed, your I's dotted. But it's an easy way to remove what are sometimes substantial assets from the client's estate. When I first started practicing, we used these all the time. Back then, as I mentioned, right, the exemption was only $600,000. And I would have clients who were young, sometimes young professionals, and so they were just starting out. And back in the 1990s, 600,000 was still not a nominal sum. And so sometimes I'd say, well, gee, we don't have anywhere near $600,000 in assets, so we shouldn't have to worry about the estate tax. But then we'd find out that they have a $2 million life insurance policy, right? And so that life insurance policy, as counterintuitive as it is included in your estate. Doesn't seem right, right? Especially with a term policy, because you don't get any benefit from it. You don't feel like it's an asset of yours during your lifetime, but nonetheless, that's how the IRS views it, and so it's included in your estate at the time of your death. There's really no reason, typically, that you need to own that policy. It really doesn't change your life if a trust owns the policy, and so that's why I say it's kind of a no-brainer. You put the life insurance into the trust, it stays out of the estate. Proceeds get distributed just like they would, without the trust upon your death. So just to illustrate, let's say we have a $5 million insurance policy on the husband, and let's say the husband's assets are at $11.58 million, right at the current exemption amount, exclusion amount. And let's say the wife also has assets of $11.58 million. Ultimately, generally speaking, the husband and the wife, they want their estate eventually to wind up in the hands of the children. Now, at the husband's death, normally what we would do is the insurance policy would be paid to the wife. The husband's $11.58 million would go to a family trust, right? So it would be sheltered there. And the wife's $11.58 million would remain with the wife, and she could shelter that upon her death. On the wife's death, the $5 million goes to the children, The $11.58 million from the family trust goes to the children, and the wife's $11.58 million goes to the children. We have $2 million in taxable income, so the beneficiaries are only going to receive $26.16 million. We can dramatically affect that by the simple use of a irrevocable life insurance trust. So we have the same scenario, same selection of assets. Husband's death, $5 million to an illit instead of to the wife. $11.58 million to the family trust. The wife still has her $11.58 million. Upon her death, $28.16 million goes into the succeeding beneficiaries, the children in most cases. That means there's no tax due, and so the beneficiaries get the same amount, but they don't have to pay $2 million in taxes. So the point is, there's lots of planning that can be done in this environment where the only thing that we're relatively sure of is change, right? Probably the least likely thing to happen over the next few years would be no change. So we're going to have some change. We don't know how bad it will be, or if it won't be bad at all, or if it'll be good. We just don't know. If it ends up being good, it generally, is not going to be harmful to you to take advantage of the current benefits available under the law. If there are additional benefits, then you can take advantage of those in the future. The big danger is if those benefits are ratcheted back and you don't strike while the iron's hot, so to speak. You don't take advantage of the increased benefits while they're available. Is it an emergency? Is it something that, we've got to urge our clients to do, by this week? Probably not. Would it be prudent to certainly start thinking about this before the end of the year and maybe have it accomplished by the end of the year? Not a bad idea. Or certainly as soon as possible thereafter, not a bad idea. But as with all estate planning strategies, my general approach is that you really do need to strike while the iron's hot. The fact of the matter is, our clients don't enjoy contemplating their own demise. Right? That's the one problem with estate planning. You have to sort of take your own demise by the collar and look it square in the face. And that's uncomfortable for people. They don't like to spend a lot of time doing that. And so my approach has always been, when the clients are motivated to do something with respect to estate planning, that's the time to do it. The further off you put it, the longer you draw it out, the more likely it is that it'll never get done, because it's usually just not on the top of the agenda of the clients for obvious reasons, right? So, I certainly urge you to talk about these things with your clients, to talk with us if you have questions. Again, my name is Chuck Borek. For those of you who don't know me, I've been practicing in Howard County for many years. I joined Steve earlier this year as special counsel. Steve and I go way back. He was actually a student of mine at the University of Baltimore many years ago. Again, Steve's not quite as old as I am, but we go back a ways. I've been working with Steve for a long time. I'm a great admirer of Steve's, and I'm very happy to have been able to step in for him today. In addition to the estate planning, my practice also involves lots of business planning and business transactions. To the extent you have clients that have business issues, choice of entity issues, transactional issues with respect to buying and selling a business, I also handle those matters. In fact, I'm the primary contact for those matters at the firm. So feel free to contact me anytime you like. You'll see the Borek Group logo on the screen. That's a company I have that does webinars for continuing professional education for lawyers and accountants all across the country. But I practice law through Elville and Associates. So I hope you've enjoyed our session today. Feel free to give us a contact if you have any questions, and that's all I have to say.
Well, thank you very much, Chuck. Appreciate your time and expertise as always in the virtual hand for a job well done, as we always say here. Chuck, are there any webinars that you have coming up? I know you're always very busy this time of year, especially, that would be of interest to our CPAs and attendees here on today's webinar?
You know, I'm trying to think. I have a lot of the webinars I do are for state CPA societies. And so usually got to be a member of the state society for that. I do
Gotcha.
the webinars for the AICPA insurgent. And I also do webinars for a company called Aurora Training. I think it's called Aurora Training Advantage. And I do webinars on a variety of topics, legal topics, tax topics, accounting topics. And I do those all the time. Those are short webinars, much like today. They never last more than a couple of hours. And if you are if you're a licensed professional and need CP, they offer CP for those courses. So I would direct you to Aurora Training Advantage for that, or to our own website for any webinars that might be upcoming.
Okay, very good. And we have a business series that we're going to be working on with Chuck. The second part of a business series, I should say, that's going to be in January. We just solidified the final date. It's going to be on January 21st at 10 o'clock in the morning, I believe. I'm going to have to double check on that.
I think it was
date. 10:30, I think. Yeah, let me just double check on that since we have a captive audience here. One quick second. Yep, 10:30 on January 21st. And Chuck is going to be discussing, what is that topic again, Chuck? Do you recall?
Did we do choice of entity last time? I can't remember if this one's choice of
We
entity.
did the business, which form of business entity is best for you?
Yeah, that was the choice of entity. I think we're doing the integration of business and estate planning or something along those lines.
That's exactly right, yes. So first part of the series was really well received, and so we encourage you to check that out with Chuck. Invitations will certainly follow, and more information as well. So with that being said, thank you again. Our next advisors forum is going to be Wednesday, January 13th at 12:30. And for those looking for continuing education credit for this advisors forum, as I mentioned before, please get your information over to me if I don't have it, as far as your ID number, and for CFP is your last 4 digits of your social security number. And if there are no questions, it didn't look like we had any questions today. Sometimes we have a lot, sometimes we have few based on the information being shared. Please go ahead and note them now before I go ahead and close out today's webinar. So any further questions? Going once, going twice, going 3 times. Well, appreciate your time today. Thanks for being a part of our webinar series, and thanks for your continued support of our advisors forum as always. Chuck, thanks again. Hope you all have a great rest of the day. Try to stay dry, and again, happy Veterans Day to everybody out there and for those veterans and their families. Take care, everybody. Thanks.
Take care. Thank you.